congratulations on this story. We talk a lot about the SaaSpocalypse, but this is really a deep dive into leveraged buyouts and what initially was so attractive to some of these private equity firms about software. That's where I want to start because, there was this joke like, oh, that's software margins. The margins on these companies for so long was so high, and that was part of the attraction.
Absolutely, because the better the margins, the more debt you can load it up with, right? The whole basically private equity business model is to use debt to lever up a company when they buy it. The debt is not borrowed by the private equity firm. The debt is borrowed by the target company being acquired.
Please repeat that last part, because that is a really crucial point when it comes to a leveraged buyout.
Isn't that a classic private equity also move?
Yeah, exactly. This is how private equity makes so much money. It's through leverage, but the key thing is that the private equity firm is not on the hook for that leverage.
Right.
The target company is, and that's kind of what's at stake right now.
Well, so let's talk about this, because I think one of the things that we keep thinking, is it one shoe to drop? Is it two shoes to drop? Is it a lot of shoes to drop? Because so far, it seems to be manageable. So tell us about kind of what we've seen, but why maybe the situation or environment is changing for some of these names.
Yeah, and so that's an important distinction to make. The SaaSpocalypse has not happened yet, right? This is all about the fears that it could be coming. So at the heart of it, AI technology has the potential to disrupt existing software businesses that were considered pretty much fine. And the fear is that, you'll have certain types of software companies especially affected. If you are providing software that's like the infrastructure layer of a company, probably okay. If you're doing data visualization and that's your main product, you can just plug that into Gemini or ChatGPT, and those business models could be especially at risk.
Can you do that easily?
That's a fair point. And that's one of the defenses people have, which is that, if you're a big corporation, you have all your, employees using certain products, you're not going to have them just go off on their own and use AI. But, Claude Code has developed very rapidly, and that's maybe taking the place of some products that would help software developers.
Is the concern specifically that with some of these types of services you describe and you write about, you would have internally people create some sort of program, maybe vibe coding, or use Claude Code to do this, that would replace paying for seats of paying like on a per seat basis for certain companies?
Exactly. And the fear is that even if this doesn't fully disrupt revenue, it could chip away at it, can maybe even just chip away at revenue growth. And that's where the debt comes in.
I don't know. I'm still, okay, I'm still skeptical of the whole thing.
That you believe that it's going to actually work and that companies are going to entrust
exactly
doing data analysis.
Part of it has to do with like the pipeline of innovation at some of these companies. Like they're constantly iterating on their products and making their products better and better for their customers. I mean, that's the way that it's worked. You can't just get one person within a company to create to replicate something that they've been paying for years, and then
Isn't
have
that
the
point?
Updates and make it better and better. I don't know.
I think this is the
I'm
big
not trying to be a
question.
defender of all these SaaS companies,
absolutely.
but
No, I think this is the big question, and this exact discussion we're having right now is what investors are trying to figure out.
Right.
Is this a real risk? Is this not a real risk? And then you get to this point where, okay, I'm an investor. How do I pick winners and losers? How do I anticipate winners and losers? And that's where a lot of the questions are right now.
Yeah, but the thing is, the bets have been made, the deals have been made, the debt's been issued, right? So then who's at risk? Like, let's Paula, carry it out. Mm-hmm. Let's say there is a SaaSpocalypse. It's so hard to say. But let's say this does happen. What does that look like? Who gets hurt? What investors get hurt? What companies get hurt? Who's on the line for the debt that ultimately doesn't get paid back, or pennies on the dollar?
So there are a lot of people who could be affected by this in the investment community. So first, let's talk about how a leveraged buyout works. So when a private equity firm decides to do this kind of transaction, they typically have two types of debt markets.
And I think we have a chart on this. I'm not sure. So, and we'll bring it up. And forgive for everybody on radio, but Paula's going to walk you through it. Yeah.
So basically, the way this works is that the private equity firm is buying a company, and it can essentially finance some of that with its own equity commitment, which is just cash. And then it can finance part of that with debt. And when it decides to finance part of that with debt, it can tap one of two markets: the public syndicated debt markets, that consists of high-yield bonds and leveraged loans, or the private credit market, which grew very rapidly starting in roughly 2020 to compete with the high-yield bond and leveraged loan markets. That private credit component is very interesting. We should never discount the leveraged loan and high-yield bond markets. Those are still very big parts of this financing process. But private credit grew a lot, and they were also willing to do more aggressive deals than the syndicated counterparts. And so, having debt on your balance sheet really creates two problems for a company. The first is you have to pay the interest expense. And the second is you have to refinance it. And both of those will have issues if revenue starts to come down at some of these companies.
Right. And we just had a chart up, but it really shows, what the title on that graphic was, how a PE fund can buy a $6 billion software company for $3 billion, because they just put up $3 billion, and then they've got the lenders on the debt side putting up the rest.
Exactly. And so what we're seeing now is basically questions over how this will unfold. Because when a private equity firm levers up a company in this way, they're doing it because they believe that they can rapidly increase revenue and rapidly slash costs so that the company can basically grow over time to adapt to its large debt load. That means revenue has to grow, right? So if revenue growth slows, or even worse, reverses at all, that makes the debt potentially untenable.
Who's at the top of the debt stack here?
So that would be the senior secured lenders. It varies depending on the exact structure, but notably the private equity firm is at the bottom of repayment, right? Because the way debt works is basically the debt investors get paid back first. Right. And if there is restructuring or bankruptcy, typically the equity is wiped out. Medallia is a very interesting example of this. It's important to note Medallia is a software company. Its problems predate the current AI concerns. It had its own set of issues, but in that situation, Thoma Bravo and his co-investors lost $5 billion, one of the largest wipeouts in private equity in years.
Well, let's talk about Thoma Bravo. I mean, people who are listen to our program, we've spoken to Orlando Bravo in the past. We spoke to him at Milken years ago in a completely different environment than it is today. We weren't talking about a SaaSpocalypse, but
no, everybody was just chasing private credit and wanted exposure and put it anywhere.
And this is a firm that for years has been all about software. So talk a little bit about the Medallia example, but also Thoma Bravo's role in this.
Yeah, so Thoma Bravo took Medallia private. It seemed like a very smart investment at the time. They used a $1.8 billion private credit loan to finance it, and specifically a recurring revenue loan. So what is common in earlier stage companies is they're not generating a lot of earnings or what's called EBITDA yet. And so an alternative is to base the loan off of recurring revenue. In old debt times, that would have been considered pretty extreme, and lenders want to see a history of earnings. But for the newer, software companies, that was considered more common. And so it also had a special feature, this is getting technical, called PIK or payment in kind, where you could basically defer some of the interest by adding it to the principal payment of the debt later. And so basically this company tried to increase earnings. It couldn't, but because it was picking the debt, the actual total debt size kept increasing, and it ended in a very unfortunate restructuring earlier this year.
Right, so the target for success had to be even higher because the debt load kept hiring because they kept adding on the interest.
Exactly. And again, that's what is hard about debt, is it amplifies risk.
It's so funny. It's not funny. We talk a lot about the software space. I mean, what do investors look for? Is it a case of a bunch of deals starting to have problems? Is it a case of a big deal? Or we just don't know? How do we know that if this is going to become a bigger problem? Is it a higher rate environment that all of a sudden makes it trickier? What's the thing that maybe tips everything over? Or all of a sudden AI is just doing everything that these companies do?
Yeah, so it's kind of twofold. So first, can a company pay its interest expense? And that's where the rates question comes in, right? A lot of these leveraged buyouts were done in the 2020 to 2022 era, and they all use floating rate debt for the most part. So as the Fed increased interest rates, their borrowing costs also increased, which caused problems and squeezed their liquidity a bit. But to
be fair, I think they thought, right, 3 to 5 years, they would be exiting.
Exactly.
And then that became problematic.
And that's the other component. As interest rates increased, valuations fell, making it much harder to sell a company. Private equity firm doesn't want to sell it for less than it bought it for. That's a nightmare, right? And so a lot of companies are basically just stuck, and they can't be sold or IPO'd right now. Then the other part of this, and the real test, is the refinancing, because a lot of the debt is roughly 7 years of maturity. And so a lot of that debt's actually coming due between now and 2029. There's about $150 billion of it across syndicated, public, and also private markets. And so each of those is going to be a test case, basically.
You said earlier in our conversation that it's unclear at this point if the SaaS apocalypse has actually happened. I think some public market investors would look at some shares of SaaS companies and the way they performed over the last 12 to 18 months and said, wait a second, it looks like public market investors have made a decision, at least as of now. When do you think we'll be able to definitively say whether or not there is or is not a SaaSpocalypse?
I think it's just going to be something that unfolds slowly in the coming years. At least in the debt markets, it's going to be kind of on a case-by-case basis.
Okay.
Well, and the other thing, if we can bring up our last chart, we just have about 30 seconds here. You have seen basically investors or lenders growing wary, right? So we do have a chart that shows buyout funds binged on software deals. But if you look at 2026, you can see that has come down dramatically.
Exactly. And lender confidence is key because if you lose access to debt capital markets, at the very least, your borrowing costs will go up even more. And in a worst case scenario, you might not be able to refinance at all. And either of those can cause a restructuring.